I'm James Turk. I'm a director of the GoldMoney Foundation, and I'm here with one of the legends of Wall Street, Victor Sperandeo, or Trader Vic, as he's known popularly among the traders of Wall Street. Vic, it's a pleasure to be with you here today. Victor's the CEO of Alpha Financial Technologies. I'd like to start a little bit by talking about the markets, where we're going. I know you have some really clear, strong views on the outlook for the dollar.
Well, this is an obvious trend. You look at what's happened in the last 2.5 years, let's call it, and every problem after Lehman Brothers has been solved across the world with borrowing and printing, debasing currencies, and keeping interest rates low. So that trend by Great Britain, Japan, the Eurozone, and the United States basically is going to continue. So you have to conclude, and this is unquestionable, there is no other answer, that you're headed towards an inflationary environment, because that's the way these countries, first of all, have solved their problems, whether they want to or not. And that's what some countries like the U.S. and Ben Bernanke want to do with this country, is solve their problems by inflating away the debt, among other things. So they devalue the dollar has to go down in the long run, and inflation has to be what happens in the future.
So it's print, print, print. You know, what they call quantitative easing is really just money printing.
Yes.
A couple of years ago, I can't remember exactly when it was, we ran into each other at a conference in New York, and the gold price was much, much lower than it is today. And you said to me that, you know, buying gold was probably one of the simplest trades you've ever seen in your entire life. Is buying gold still your favorite trade?
Well, what I said was I couldn't figure any scenario where it could go down. But that was a little lower level. Here, I also believe that gold can only go up unless things change. Now, if things change, gold may change. I just don't see any reason for any change that any government is promoting that would make gold go down. Yeah. Now, the only difference is because we live in a very leveraged environment in the commodity world. 10%, 5% margins. Locals, the people who trade on the floors or professionals, use a lot of leverage because they look to get rich in a week. I mean, rich in a generic sense. So the key is, when things change, the gold and silver markets, especially those two, will be extremely volatile. Silver far more than gold.
And that's what we're presently seeing.
That's what you're presently seeing. But the key is, you know, it's unquestionable that you have to have a percentage of your portfolio. Now, this may differ 10%, 5% if you're an institution, maybe as much as 20% if you're a hedge fund, in gold as, if you will, an insurance policy, a hedge, and basically it's been in an uptrend for 10 years. There's no reason to see it change. So gold is still a buy. The only difference is that really you should buy it when it sells off, like now. You know, I don't buy gold in an uptrend where it's moved up 10 days in a row, 5 days in a row, etc. So yeah. On weakness, it's still a great trade and a great investment, actually.
But even if you buy it on a temporary peak in a bull market, eventually the bull market's going to bail you out, because the long-term trend is going to take the price much higher over the next several years.
Correct. It's a little bit of this Trader Vic handle I have. You know, I like to buy
I was looking for the bargain.
I was looking for anything in weakness, because the public, you know, and I don't know who I'm talking to here, but, you know, the public gets very upset if they buy something and it loses 5% in a week. Gold last week lost 4.2%. Nothing in my world. But the point is, most people, you know, get scared. So to try to get them into a good entry point, they should maybe buy in weakness, like now. I mean, you know, gold is sold off. It's been temporary now with a small minor correction, I would call it. So this is a good time.
The $1,500 area looks pretty solid to you then, in other words, in terms of a buying opportunity for gold.
Absolutely. Still, as long as nothing changes gold is going to appreciate.
And when you say nothing changes, you're basically saying nothing in Washington changes. In other words, if we continue down this road of spending and spending and borrowing,
Correct.
that's going to debase
Correct.
the dollar,
Correct.
and gold's going to go up in dollar terms as a consequence.
Correct.
And you don't see anything happening in Washington to suggest it is going to change?
This is the Hatfields and McCoys. I mean, you've got the Republicans and the Tea Party swinging the votes, and you've got effectively socialist Marxists on the other side. So, you know, how the twain will meet, I don't know, but certainly till 2012 election, it's not going to change.
Are we going to make it to 2012? In other words, you know, they're talking about a $2 trillion increase in the national debt in August to buy time to put more debt on until 2012. So it's obviously no political will today. They're just kicking the can down the road. Is that going to be a wake-up call for the market that enough is enough?
I think, well, it wouldn't be that easy because the Republicans want cuts in spending of some sort, okay? They are asking for the equivalent. So you have to see how that plays out. But here's really, let's just say the essence of the short term of 2012. I believe the markets will probably make it because you'll probably get a QE3. And by the way, Bernanke has clearly said in the minutes of the Fed, the August 27 minutes, that he leaves open anything he wants to do. He can adjust his the portfolio is what it says. But the key is that what happens to there are two items that are going to create whether we make it past the election. Number one, is the U.S. economy and the world economy going to go into a major double dip? If that occurs and therefore the debt gets structured to go way up in terms of the forecast, because GDP is going way down. So GDP gets called to go into a recession again. Mm-hmm. Therefore, tax revenues go down. Therefore, the debt goes up. And therefore, the projections of future debt, which are now looked at as very beneficent by bond buyers, well, if that happens and the bond buyers back away, then you will not get to the election before major events cause turmoil.
Yeah.
So that's one, and the Middle East, certain war events in the Middle East would be another problem for governments to solve.
Disruption to the oil supplies particularly.
Exactly, and therefore the deficits would get higher and oil would go way up and cause GDP to go down.
Yeah, what we have now is we have a structural deficit and nobody seems to be solving it. Are bond buyers really the force that they used to be? Given the fact that most of the debt is now being actually bought by the Federal Reserve, are the private market bond buyers a force?
Well, it is true that QE2, the Fed has effectively financed the Treasury's needs plus. So if it stops in June 30th, then it's got to depend on other bond buyers. Now, if there are no other bond buyers and they are backing away, like Bill Gross did by selling his $28 billion of Treasury securities, you will then also have major problems in the economy, and you won't make it to 2012 without a crisis. But assuming that if you, for example, the last budget that Barack Obama put out, which was right after the CBO budget, which comes out in January, they project 3.7% average debt to GDP annually for the next 10 years. Now, bond buyers wouldn't think that that's horrible. Okay, it's not like it is now, 10, 11%. Mm-hmm. So if that projection gets lifted, okay, from say 3.7 to 8, well then there will be no bond buyers, and logically speaking, because why would you be buying into what is going to be a major increase in the cumulative debt?
Right.
So those are the things that I think are subtle here. It's do we go into a double dip? Do we have outside forces that cause the double dip, whether we care about it or not, and we have no control?
But it looks like we are going into a double dip now, don't you?
It does.
Yeah. So
it does. 1.8% GDP with all the stimulus from the Fed and QE2 printing, effectively buying $900 billion worth of debt with the rollover.
yeah, it's like they put the foot on the pedal and they flooded the engine, and the engine just isn't, you know, turning over.
Correct.
And you know, it looks like a double dip is all but certain. I think this is what John Williams of shadowstats.com is also suggesting.
Right. Well, he is a great analyst of the real numbers. Yeah, a double dip looks highly likely, and you know, just to put a reason on it, the Obama administration is doing everything it can to cause uncertainty to business people to start businesses and put capital up and take risk. And there's very little of it, I should say. Mm-hmm. So the fact is that with this uncertainty over tax increases, with the healthcare issue is still up in the air, what the budget deficit is going to be, the budget is going to be, if you will, all of these things make people hesitant. If you had $100 million in the bank, maybe you do, and if you do, if you had that though, why would you risk when you don't really know what's going on? See, those are the people that really, they are the ones that make the decisions, but their decisions are of growing businesses and starting businesses, but they're going to be influenced by what they think the future is going to be. I mean, they're not going to risk their money unless they think there's a pretty sure reward.
Yeah, and that's actually contributing to the weak economy. There just isn't the job growth that one would normally expect after coming through what we came through.
Exactly, especially with 30 months of zero interest rates.
Yeah.
This is 30 months of zero. I mean, you have to go back pre-war to find that kind of scenario.
Which is actually quite interesting, because imagine what the federal deficit and debt would be now if we had normal interest rates. Because, you know, we're at $14 trillion debt. 1% on that is $140 billion additional deficit that the U.S. government would be incurring.
Correct.
And, you know, so 5% would be, let's say, a normal historical interest rate on government paper. You know, T-bills now are, you know, 0.5%, if that.
No. T-bills are 3 basis points.
3 basis points.
As of this morning.
Yeah, so, you know, it's going to be a big impact in terms of the debt. So
Huge.
Higher interest rates are actually a problem as well, because what that will do is cause more federal spending to pay off the interest expense, which will cause more federal borrowing. So they're
correct.
Really between a rock and a hard place.
In this case, the higher interest rates, again, I've done this study, so I might as well give you the free statistics of my research. In 2020, in 10 years, right now, the cumulative interest payments as a part of the total debt is 8%. If you use the CBO numbers, which they get from the Obama administration, in 10 years it'll be 21.5%, using their numbers. Now, where's the difference going to come from? And that assumes the Bush tax cuts go away. Mm-hmm. So they assume that taxes and total tax collections are going to be in the 20.5% range for the whole decade. And therefore, with that, it's still going to be 20.5%.
But that's unsustainable.
It is. It's 21.5%. You can't, in other words, you can't find the difference. So there is really, if you don't change in a major way, this is unsustainable. It doesn't work.
So even the Republicans' proposed budget really is not enough to bring about the change that's necessary?
Not if you assume a 4.7% average interest rate.
Yeah, and because they're also, I think, have some pretty rosy projections in terms of what they're talking about for economic growth, which, you know, raises some questions whether those are realistic as well. And they're not proposing to bring the deficit down until, I think it's 2027, if I'm not mistaken. So, I mean,
you'll never get there.
Something will happen before.
Well, that's under these conditions, you're not going to get past 10 years, because like I say, where are you going to get the other 14? The difference between 8 and let's call it 22. Where are you going to get to 12%?
Yeah.
And that assumes the end of the Bush tax cuts, which is not a sure thing.
Yeah. What is going to be the tipping point, do you think, that, you know, really sort of brings all of this to a head? Because, you know, obviously people all around the world are doing their numbers and they're looking at saying that this is not sustainable. You know, the U.S. is living far beyond its means. It's not addressing the issues of all of the continuous reckless spending that's going on in Congress, the accumulation of debt. What do you think is going to bring it to a head?
The tipping point here is psychological, and it's in this respect. it comes to the bond holders, T-bill holders, bond holders, and the new bond buyers. Okay. So if they believe that they're not going to get their money back paid in similar purchasing power dollars within reason, they will sell the bonds as Bill Gross did, or it certainly wouldn't buy any more bonds. So the tipping point is when you start to project the GDP to be lower and deficits higher, bond buyers, in this case, not in the normal case where normally you buy bonds in a weak economy. In this case, I think the bond holders will sell. You know, I just came from Brazil. 1993, Brazil suffered inflation of 2,000%. By the way, that's about 28.5% compounded monthly. The highest month was 83%. And they effectively wiped out the debt by inflation. And it worked. I mean, right now, Brazil is a part of the BRIC, you know, and it's the B in the BRIC. It's an emerging country, and they sell a lot of commodities, so they're doing very well. But they literally wiped out their debt by increasing their money supply by 10,000 times. That's how they solved the problem. So, you know, I think this is what Bernanke wants, but on a much smaller level. I mean, he's not talking those numbers, but basically that's the only way out. So if you start to go into a double dip, because the economy's sluggish, bond buyers should do what Bill Gross does, is sell. What Bernanke's answer is more QE 3s and 4s, and therefore you get into an inflationary environment where bonds are certainly not desired. So that's the tipping point, is when GDP starts to be projected as going down. They keep next year 3.5%. See, as long as you have those kind of scenarios, nobody panics.
They, putting the rosy forecast on it, they tend to think that we'll sort of work our way through the system. But if we do get this double dip, and there's a lot of evidence to suggest that we're going well into it. Housing, for example, is turning down very rapidly again in many parts of the country. The tipping point could be reached maybe this summer?
Well, that's a little trickier to call because you see, you need, I mean, the way it's viewed by the world mostly is they take a consensus of economists. So you have 50 economists. Most of those economists are Keynesian liberal economists. And therefore they're going to skew the numbers to, you know, to make it look a bit more rosy than it is. So really what you have to do is play that a little bit week to week using your own judgment, because it is a difficult thing to do when a government doesn't want to tell you the honest opinions of what it's doing, and they all hide these numbers. So you have to start to see this being very obvious, and then also what the budget is going to wind up being, you know, how much of the spending is going to get cut. Some of it certainly will. How is it going to be effectuated? Is it going to be a lot this year or next year? And those things are a little bit subjective because we don't know what the outcomes will be of those questions.
Yeah, are the problems in Europe, the sovereign debt crisis, and you know, Greece is coming back to the headlines again because it's clear that the previous bailout wasn't enough, and it's not really working properly, and they're in the hole again and have more problems to deal with. Are those problems in Europe actually helping the dollar in the sense that it's making people look at Europe and say that problem's bad there, maybe I should stick with the dollar?
Absolutely. And there's a lot of shorts in the dollar, so it's helping. When the euro sells off, the dollar rises. and that's really what saved the dollar. It's caused this commodity sell-off. But the euro can't sustain itself the way it is. I mean, it's going to disappear. And if you like Angela Merkel, I say this, cut her picture out and put it on your refrigerator, because when the full election comes about, she's gone. The German people have got it. The people who pay taxes get it. They're not going to give their money to a higher cost country that retires earlier than they do. That game is over. So Greece is going to be either thrown out of the European Union, if there's such a, if I'm phrasing the concept properly, but they're going to default.
The promise to the German people was that the ECB would be run like the Bundesbank and that the euro would be managed like the Deutschmark, but obviously the promises are being broken. And I think the clearest example is after the Greek crisis last May and the politicians got together, the ECB announced that they're going to be buying sovereign bonds after pledging many, many times that they weren't going to do that. So it made clear that the ECB is under political control, not like the Bundesbank, which really guarded its independence. Is that part of the reason, in your view, that you're saying the euro is going to have problems?
Yeah, it can't bail out. The original rules. Let's just December a year
2000.
and a quarter ago. The rules were that you don't bail the members out.
Yeah.
Not only have they bailed out Greece, it's like belonging to a club. You don't pay your dues, they usually throw you out of the club. In this case, not only they didn't throw Greece out, they paid their other bills. They paid their car payments, their house payments. It just can't go on. And then, of course, you saw the other countries, Ireland and Portugal, and the really bigger potential would be Spain and even later than Spain, Italy. You can't keep bailing people out. So the concept of the euro works as long as people can discipline themselves to be reasonable in their spending habits. But what we've proven, and that's why there was an original gold standard in the U.S. and not a paper standard, is because politicians can't discipline themselves because they care more about their jobs than they do about their country or their people. So it's 2 and 2 to me that this kind of thing happens. But the key is there is no more bailouts per se as we've seen them, and therefore, to me, the European Union will start, if they're smart, they'll lose a few members and they'll stay intact. But if it starts to come apart at the seams, then everybody, then it'll really be a disaster for the euro, and Germany will be a great place to be, but I mean, it's after the fact. But, it's not going to survive as we know it.
Yeah. What's more likely, that they'll kick out Greece or Germany's going to withdraw itself voluntarily and reestablish the Deutschmark?
I believe Greece will default before that happens.
Before that happens, they're going to try to save the euro at all costs, regardless of the political winds in Germany at this moment in time.
Correct. That's Angela Merkel's mindset, I think, and so is Sarkozy.
Yeah, okay. Just turning back to the markets again, we talked about gold, talked about interest rates. What about silver?
Well, silver, let me just put this into context. If you ask yourself what the volatility was of silver using standard deviation for the last 10 years, it's 32%. It's more than double the S&P. It's far more than the NASDAQ. It is the most volatile object on the face of the earth. Also, I do this for a living. If you try to build an algorithm that makes money trading silver, and we tested, and I'm not exaggerating, 218 of them with various trend-following rules, weights, different weights, short-term, intermediate term, the only ones that make money are long-term. Okay, so more than a year with a simple weighting like 1, because they're fundamentally driven. So if you try to do something sophisticated, which is what I attempt to do all the time, and find these little trading rules, you don't make money in 218 different variations. None of them make money over the longer run. So the only one that makes money over the longer run is long term. So what it shows is gold and silver, in this case, are long term, fundamentally driven objects. So you got to think long term. Now, with that said, the volatility in the last couple of weeks has probably risen to about 60 and from 30. Now, it started with margin. Why was margin raised? It was logical, by the way. I agree with the Comex. You start off, it doubled in 3 months.
Yeah, the price had risen so much.
So when it was 25, the contracts that trade are $125,000. It goes to 50, now it's $250,000. If your margin is $11,000 at 25, it's got to be higher, over $20,000 at 50. It's normal. The clearing corp does this to protect the integrity of the members who guarantee the clearing corp. So there's nothing wrong about that, but there's a lot of leverage in silver and a lot of traders, and it went up 9-10 days in a row, so it sells off and you get a correction. Normal corrections, by the way, are measured from the move that takes place to the peak of the new move. So say 25 to 50 is $25. So what you want to measure to know if you're still in an uptrend is the percentage correction of that move. And that would be the normal, you've heard this a million times, you've read it in books, 1/3 to 2/3 of the previous advance. So we got 2/3.
Well, actually, I would probably go back to $17 or $18 last summer and take that as the base. So if you, let's say 17 to 49, divide that by 2, you get 16, you get 33. You're 50% retracement of the move.
You could look at it that way too.
And 50% retracement is basically a very bullish.
It's not unusual, it's normal.
Yeah.
Okay? You can utilize that measure as well.
Yeah.
But the key is when it went up big, it's now correcting, and it's still in the bull market. Now that's the background of it. The fundamentals of it is that, and again, I've done some research. There's supposedly 65% of the mining of silver is used for industrial purposes. Flat screen TVs, film, you name it, all the various things that silver is used for. So 35% of it is investment. So if you mine 100 ounces of silver, 35 ounces get purchased by people like you and I, and we hold it as money. Now, in the gold's case, it's 90%. 90% of gold mined, and these are, you know these numbers far better than me, but approximately 10% is used for industrial purposes, 90% is saved. Now there's 3.3 trillion ounces of gold, and by the way, correct me because you know this, as you say, better than me. and if you figure that that's of investment, well, there's under 60 million ounces of silver versus 3.3 trillion in gold. So there's very little silver relative to gold. Now, although it's volatile, because it is basically traded aggressively because it's a low-priced object versus gold, and the leverage is immense, so it moves around a lot, but still the fundamentals for silver are no different than gold. They're very positive, and there's just not enough silver in the world for the demand. Now, some comes from scrap and recycling, and India was a seller of silver, for example, for the last 5 years, and now they're a buyer. They're supposed to buy 1,000 kilogram tons of silver. So silver is in a major uptrend. It's basically no different than gold, except that it's used more for industrial purposes. So it's actually it's better than gold in theory.
Yeah, in that sense that it has an economic use besides its use as money, as form of economic calculation. Yeah. But, you know, gold, you can always use it for decoration, too, at the end of the day, as many Indian women do. You know, they save their money by putting it into a necklace.
Gee, I give all my girlfriends silver.
Any words that you'd like to use to wrap up this discussion? You know, this video is going to be viewed all around the world by all types of people, average Joe as well as some sophisticated traders. What would you recommend going forward for you?
Look, the main key thing in making money in the markets is to have a theme, and if that theme is fundamentally driven, you have to have a reason for it, and you're making money from the theme other than 1 week or 2 week small minor corrections, which you know, mostly, by the way, the pause here, TV, they don't use percentages. They use, gold sold off $100 this week. Well, they sold off 4%. You know, they don't use normal percentages. So the key is to have this theme and to stay within the theme. Now, as long as you see governments printing, debasing, borrowing, and keeping interest rates at below zero, real interest rates are below zero. In effect, they're stealing from savers. Well, you've got to be long the precious metals, and you should have other commodities as diversification too.
So basically, tangible assets are the key for going forward from here.
Exactly.
Trader Vic Sperandeo, thank you very much. It's been a real pleasure.
Thank you.